Still dealing with calls, only this time we're dealing with selling calls. I'll repeat myself over and over again. Repetition is the mother of all skill. There are only two products. There are buys and calls, right? Which gives four fundamental positions. You can buy calls, buy puts, and sell puts. When you buy something, you expect to pay for it. You will pay premiums. When you sell something, you expect to get paid for it. So in this case, we're dealing with this one here. We are selling calls. So we can expect to receive cash up front for it. And we also have to provide liquidity, okay, which means if we sell somebody the right to buy something, well, they have to buy it from someone. So that's the risk we take. Okay, a call is the right to buy if the price goes up. That will always be true, and that should be etched into our minds. A call is the right to buy if the price goes up. Whether we're buying that or selling that, that's what it is. Now, as the seller, this video is only dealing with selling calls. As the seller of a call, somebody has bought the right to buy if the price goes up. So the moment the price does go up, they need to buy it from someone. That's our obligation. Now, because we have that obligation and that risk, we get paid cash premiums up front. It's worth mentioning that 70% of all options do not expire. They are actually sold or the position is closed before they expire. That's worth mentioning because that statistic comes very useful when you're trading. The core concepts remain exactly the same. We still need to know if it's a call or if it's a put, if we're long or short, that put, the strike price, the expiry, the price that we paid for it or received for it, and if it's in the money or out of the money. Those fundamental concepts do not shift. Okay, a call is the right to buy if the price goes up. That concept needs to be concretely etched into your mind. Say it a dozen times until you get it. A call is the right to buy if the price goes up. When we sell a call, we are selling the right to buy if the price goes up. All right, we have different obligations for selling a call than we do as we do when we buy a call. Okay, if we sold a call in June, for $4.30, we've sold the right to buy to somebody else. Okay, so somebody else thinks that the price is going to go up. Okay, if it expires in September, okay, so when September comes around, it's worth about $3.85. The strike price is $4.30. Clearly the price has not gone up. All right, so they've paid us premiums. They bought from us an option. They bought from us the right to buy if the price goes up. The price clearly has not gone up. All right, so they do not get to exercise their option. It's worthless. They're not going to buy stock from us for $4.30 when they could buy it for $3.85 on the market. Okay, so their option expired, worthless, and we get to keep the premiums. That's why we sell calls, by the way. We sell calls because we want, or we sell options because we want the premiums up front. We're just taking a different position to everybody else. They think the stock's going to go up. We think it's going to stay the same or come down. Either way, we are selling an option and getting paid premiums for it up front. Example 2, if we sold a call in mid-July with a strike price of $4.20. Mid-July, $4.20. Okay, when it expires, with an expiry of when? Late July. Okay, in this example, we're selling a call for $4.20. And at the end of July, I think if we zoomed in close enough, I think it's about $4.21. So that's a tricky one. They probably are not going to exercise their option. They could, but it'd almost not be worth it. The money it would cost them to exercise their option, they could just buy it at market for the same price anyway. Okay, so in that case, you'd probably get lucky and you probably get to keep the premiums and you wouldn't lose anything either. You wouldn't have to provide liquidity to the buyer of that option, which is lucky for us in that case because that happens a lot. And I think up here we've said it expired at $4.30, but in closer inspection, if we do, it came up here to $4.30, so they might try to sell their option at that point. They've bought one, they could sell it, it would be worth money here. But on expiry, as far as we are concerned as the seller of that option, it expired pretty close to $4, sorry, it's $4.25. So in that case, yeah, they would probably exercise their option. But you never know, it might still cost them more than that 5-cent gap to exercise that option, so they wouldn't bother. Okay, the point is that the fundamentals here are that their options contract would be 5 cents in the money upon expiry. So $4.20 where we sold them the option to the end of July when it expired at $4.25, or the price is $4.25. You get it. If you sold a call in mid-Feb with a strike price of $4.20, mid-Feb, $4.20, okay. Expiry of October. That's a long expiry, by the way. From mid-Feb to October. Most of the trading strategies that I employ are like weeks to months at most. But so that we can cement the concept of selling calls in your mind, how would this work out? If we sold a call in mid-Feb, if we sell a call, we are selling the right to buy if the price goes up. Okay, so on expiry, if the price is higher than $4.20, we have the obligation to provide liquidity and sell stock to whoever bought the option from us if the price is higher. The price is not higher in October. Okay, so this option expires worthless in October. But the point that I'm trying to make in this example is that for most of that time, we would be sweating. For all of this time, their contract, their right to buy at $4.20 has value because the stock price is almost as, well, it's $4.45. Okay, so that's 25 cents in the money. That's a 25-cent discount that we would have to sell them stock. We would own, I think this is Telstra stock. So if we sold that call at $4.20 in mid-March, we would have to own this stock or be prepared to buy it to sell to them. We would have to sell it to them at a 25-cent discount to market price. So we'd have to sell it to them, at worst case scenario, here at $4.45, and we'd have to sell it at $4.20, because that's 25 cents per unit. So over 100 units, that stacks up. Okay, but ultimately, if you were calm and confident that the price of this stock was going to come off, you wouldn't hedge your bets, you wouldn't cover yourself, because ultimately the option does expire worthless in October, and you get to keep the premiums. They bought a contract from us, they paid us for it, we get that cash. And for all this time, this is what we get paid for, is the risk that the price stayed up here and that we'd have to actually provide liquidity at a discount when it expired. If we sold a call in June with a strike price of $4.40, June, $4.40, if we sold a call up here, well, we're very happy because the stock price comes off, but when does it expire? The expiry of August. Okay, so in August, the highest the price gets is $4.30. Okay, so when it expires in August, it expires worthless. They're not going to pay $4.40 for stock that they could buy at market for $4.25. Okay, so their option that they purchased from us and paid us premiums for that we get to keep would expire worthless. That's the best case scenario when selling calls. If you sold a call in January with a strike price of $4.20, January $4.20. Okay, so the point that I think I'm trying to make here is, well, that I know I'm trying to make here, if you sold a call for $4.20 at any point in January, that's quite out of the money, right? So you're not going to get a lot of money for that, right? People are going to expect that they can buy that product very cheaply because the price is, for half of January, it's down here at $4 or $3.95. Okay, so you're not going to get a lot of money for selling that because it's well out of the money. Okay, out of the money means it doesn't have value yet. If it expired, or would the option expire worthless or in the money in late March? So $4.20, we sell it here, and then in March, late March, I think it expires right here at like $4.21 or 22. So this is another scenario where they may or they may not exercise their option. Even if they did, you still get to keep these premiums, so you may come out on top even if they did action their option to buy if the price went up, which it did by expiry. So for the most part, it fooled around down here under the strike price. But on expiry, which is the date that counts, it expired in the money by 2 or 3 cents. So would the option expire worthless or in the money? It would expire in the money. But in this case, it's just a question of whether they would action their option or not. Could you sell a call with a strike price of $4.50 in June? June, $4.50. Same point. You could, but not a lot of people are going to buy that because that's well above all-time highs or recent highs. You're not going to get a lot of money for that, but you could do whatever you want. You could sell one at $10 if you could find a buyer, which you're just not going to. Nobody's going to pay for that option because nobody realistically thinks this price is going to go that high. Could you sell a call with a strike price of $3.80 in March? It's March, $3.80. You could, but realistically, why would you? You're going to want a lot of money for that because immediately upon selling that contract, well, for most of March, the price is well above that. We're dealing with $4.03 anywhere up to $4.22. So at any one moment, this is already 30, 40 cents in the money. So if you were to sell that, and people would buy that if you were to sell it cheaply enough, but you're already selling a huge amount of value, so you'd expect to get a lot of money for selling that contract. It's much more likely that you'd sell just out of the money, because anybody buying a call is expecting that the price will go up. If they do expect that the price will go up, they're happy to pay less for it, depending on how confident they are that it will go up. So could you sell a call with a strike price of $3.80 in March? You could, but you'd expect to get a lot of money for it. It has a lot of value already. The difference between $3.80 and $4.05 and $4.20, which is the average price around here, is big. So you'd be selling an option with a lot of inherent value. So the answer is yes, you just probably wouldn't. A call is the right to buy if the price goes up. That will always be true. Okay, whether or not you sell the call or you buy a call, it is an option which entitles the buyer the right to buy the stock if the price goes up. Why would we sell a call? The main reason that anybody sells options is to get the premiums up front. Okay, that's why we sell stuff, is to get cash. Okay, now we are taking a position, if we sell calls, we don't expect that the price would go up. If we knew the price was going to go up, we wouldn't sell calls. We just wouldn't. Okay, so the reason we sell calls is to get premiums, typically, or as part of a multi-leg strategy. Much more on that later.